Hi, everyone. This is Mike Wilkerson, the founder of Stormwall Advisors, the host of Stormwall.com, and the author of the book, Why America Matters. I wanted to come back to you today and talk a little bit about the costs and the consequences of the Silicon Valley Bank bailout. So we've been talking about this a lot, but banking regulators, along with the board of directors and the management of Silicon Valley Bank, each failed to see or prevent the problems that destroyed in less than a week one of the largest banks in the country. The regulators, whose mandate is explicitly designed to prevent this kind of a disaster, allowed SVB to grow too fast while effective controls were not in place. For example, no chief risk officer was in the seat for 8 months until January 2023, at which point it was too late. Over the course of 2 years, Silicon Valley Bank's assets tripled in size from $71 billion in the end of 2019 to $211 billion just 2 years later at the end of 2021. And while deposits also tripled, they were low quality demand deposits that could be withdrawn immediately at the first whiff of trouble. So the bank grew these deposits too fast to find creditworthy customers that it could lend to. So instead, the bank invested over $100 billion of its liquidity in investment securities, which, when interest rates rose, resulted in billions of dollars of losses. Depositors got wind of the depth of the issues at SVB, and within hours, SVB has exploded, casting shrapnel far and wide across the banking sector, which was subsequently set on fire. Now, rather than preventing the emerging catastrophe before it happened, the Federal Reserve, the FTC, and the U.S. Treasury belatedly stepped in to clean up the mess, recognizing over a panicked weekend that the issue was now much larger than one bank headquartered in California. This was clearly a systemic crisis in the making, and emergency measures were required to address it. So these regulators took the actions that they had learned and derived from the playbook established during the global financial crisis, which was to provide ample liquidity, the Fed's role, to protect depositors, but not shareholders or unsecured creditors, which is the FDIC's role, and to backstop the whole thing with credit enhancement from the U.S. Treasury. Yet none of these actions convinced the market that the blast radius could be contained, as seen by the deposit flight and market mayhem that continued throughout the following week. So what are the costs and consequences of the bailout and the government's actions? Well, by guaranteeing the uninsured depositors of Silicon Valley Bank, the Fed has once again bailed out Wall Street, Silicon Valley, and the billionaires behind both, at least for now. The FDIC's insurance limit of $250,000 per account, which was designed originally to protect the middle class and small businesses, is now more or less meaningless. I mean, guaranteeing all deposits lead to what is called moral hazard. And the idea behind moral hazard is that it encourages, whether it be banks or investors or speculators or whomever, to take greater and greater risks under the assumption that any losses will ultimately be covered by the government's next bailout. And that's exactly what we've seen happen here. So rather than increase safe and sound banking practices, this bailout will make the banking system even more dangerous. So now we see that all banking deposits appear to be implicitly backstopped, and the government's rescue package, however, is nowhere near the amount required that would be required to prevent a systemic bank run. So the $25 billion that the U.S. Treasury put in as a backstop to the Fed's lending program, along with the FDIC's deposit insurance fund, which is about $128 billion, this is a drop in the bucket compared with $18 trillion of U.S. deposits. And this is where the problem begins to emerge. Another aspect of it is that it's clear now that too big to fail banks that are still in play. So the four largest banks in the U.S., including JP Morgan, Citi, Bank of America, and Wells Fargo, collectively, they hold a third, about $210 billion of the total banking system unrealized losses on investment securities. In other words, the same problem that got Silicon Valley Bank into trouble. But in the meantime, they are the biggest winners amidst the chaos. A lot of the deposit flight over the last week, where depositors were pulling money out of the regional and smaller banks, flowed into the larger too big to fail banks, and that is likely to continue. So the result of this is that the concentration of banking sector liabilities, i.e. deposits, is now moving into the hands of the big banks even further, which will make the banking sector more risky systemically, not less. Now, the other aspect is that the American taxpayer is absolutely going to bear the cost of this program. Following the announcement from the regulators last weekend, President Biden said, quote, "No losses will be borne by taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund." Well, this is not the whole truth. for where do those banking fees come from? They come from the fees that the banks themselves charge to their customers, including U.S. businesses, individuals, and others. And of course, any losses actually realized on the Treasury's backstop of the Fed's program will ultimately come out of taxpayer money. So taxpayers will bear the brunt of this ultimately. The other aspect is that we're now at a point where inflation is poised to regain the upper hand. With the Fed's interest rate hiking cycle now basically unable to advance further, we can expect no further interest rate rises at the next Federal Reserve Board meeting later this month, later in March of 2023, which basically means we're back to quantitative easing in one form or another, whether printing money or otherwise, which of course is the very issue that brought us here in the first place. The other thing I would mention is, and this is one of the most significant, is the cost of borrowing is going to increase for everyone. Risk premiums are going to go up even if the Fed funds rate flattens or goes back down. So as banks incur more losses and watch their capital base deteriorate, lending will be restrained. This will lead to a credit squeeze, and it will be the small and medium-sized businesses that will likely be most severely impacted. So this means that economic growth will slow for the foreseeable future. It'll be constrained by credit, by the unavailability of credit, and it means that a recession in 2023 is more likely than it was before. So just to conclude, the regulators took the actions that they understood to be the only way possible to prevent the financial contagion and a widening of the crisis in the banking sector. But a week later, as other banks are facing increased strain, as both depositors and investors continue to exhibit some form of panic, one form or another, the plan does look to be failing. Regardless, whether it fails or succeeds, these regulators should be held accountable for allowing the situation to reach this point at all. This is going to continue to evolve and play out over the next few days. If you've enjoyed this, if you're getting benefit from the series on the banking crisis, financial markets crisis around us, if you've liked this video on YouTube, please do like it, give it the thumbs up, share it with those you think might have an interest in learning more about what is going on around us in a way that hopefully is easy to understand, and subscribe to the channel here on YouTube. Check out my writings on this and other subjects at stormwall.com, and we will see you next time. So thank you for joining.